Underway. Let's give everyone a big wave. Welcome, everyone. This topic, no doubt people are going to have to breathe deep through this. Money's always one of those things that can bring up a lot of stuff for us. But I'm sure you know it's very, very important, especially being business owners, not only living in the world. Show of hands, who here's living in the world? I think that's most of us. And being a business owner, we need to understand money, correct? We need to understand how to make it. We need to understand how to keep it. We need to understand how to invest it, which is why I really doubled down. How long in the last probably 10 months, something like that, I've been learning from you, Joel. It's been a little while, but I really went all in on learning from Joel, not only because of his expertise being a hedge fund manager, knowing everything in the industry of the market and stocks, and he knows a lot about crypto, real estate. He knows a lot of different topics. But one thing I followed his guidance through was learning how to invest in stocks and learning what to do with your investments. Because when we know how to make and create money, we need to know what to do with it. Right? We need to have that savvy mindset, because I had a fear that if I create a lot of money, I don't know what to do with it. And it kind of restricted a lot of money coming through. Has anyone else felt that? If you're unsure of what to do with it, what to do next? But if you're very, very clear in your mind of what to do, how to do it, and you've got the steps in place, it opens up this energy that just welcomes more. So I wanted Joel to jump on here to walk through his 5-step stock screen. This is the stock screen he goes through and that he taught me to basically evaluate some stocks, basically evaluate which ones are going to be in your advantage, right? We don't know what's going to happen. Joel will tell you that. We don't know what the hell's going to happen, but put things well in your advantage so that they work in your favor. The majority, high percentage of the time. Or more than percentage of time, according to chance. So he's going to go through this. There's going to be I guess you're going to go through a lot of numbers, Joel. Is that it?
Yes.
Okay, because there's, I want everyone to breathe through this, because it's going to be quite a lot if you haven't heard of this sort of strategy before. I know with me, it was a lot of time to just get to know what the hell's going on and what everything means. But once you understand it, you can run through the stock screen for a company in minutes, right? It doesn't take long at all once you understand it. Once you know where to get the information, what to look for, you can run through 10 companies through this stock screen in 10, 15 minutes. It doesn't take all that long once you understand it. So you can all listen and watch back as I upload the recording. But I want you to breathe through it just for the initial part. All right. Just breathe through it. And then at the end, if you got questions for Joel, you can definitely ask away. But before we get started here, Joel, give us an understanding around your background, your introduction to investing, and give people a bit of an understanding about you.
Thanks, Tyson, and thanks all of you for attending live here, and those of you watching the recording. As Tyson mentioned, I am a former hedge fund manager. If you'd asked me in 1993, 30 years ago, what my dream was, I would have told you hedge fund manager or money manager. I had a dream, although I was working at an insurance company, coding, I wanted to manage money. It was my hobby. In fact, on the weekends and evenings, I analyzed and picked stocks. And I said to myself, wow, how cool would it be to align my hobby and my career? Well, 15 years later, I had done that. And in 2008, I joined Citigroup here in the US as a hedge fund manager. They gave me $300 million to manage without any experience. How cool is that? And it was 2008. Some of you may remember, I know a few of you are quite young, but the market here in the US was down 40%. Financial companies were down 57%. Those were the only ones I was investing in. And I did manage to make money that year, made more money the next year, and eventually started my own hedge fund in 2013, launched and made some good money before having an epiphany that I should be teaching people the truth about money. And so I shut down my hedge fund in 2016 to coach. And so I call myself a prosperity coach, teaching people the truth about money, money mindset, money manifestation techniques, and of course, investing, which we're going to be talking about here this morning, this afternoon, this evening. So before I jump into the 5-step stock screen, Tyson knows this, I'm all about mindset. Money mindset is critical because if you don't have the right mindset, you're going to be buying when you should be selling and selling when you should be buying. So how can you develop a positive money mindset? One, affirmations. What affirmations are you doing around prosperity and abundance every day? Are you saying I am a money magnet? Are you saying I'm an excellent money manager? Are you saying lucrative opportunities always come my way? Now, the second part of affirmations is believing what you're saying. Because if you say I'm a money magnet and you don't believe it, don't say it. On a level from 1 to 10, belief level, if 10 is absolute faith and 1 is massive doubt, if you're a 1, when you say I am a money magnet, don't say it. Soften it. I'm on my way to becoming a money magnet. I allow myself to be a money magnet. Soon, I will be a money magnet. So that's affirmations. I'd also say that it's really important to become financially literate. Binge on my YouTube channel. I got over 700 videos there to make you financially literate. Today, we're going to be learning about investing, but I will say you need to acclimate yourself to wealth and abundance and prosperity. How can you do that? Hang out with wealthy people. If you don't know any multimillionaires or billionaires, I can name a few. Elon Musk, Jeff Bezos, Steve Jobs, Bill Gates. Binge on their information online. Hang out with them. You can hang out with me too by watching some of those videos on Instagram and TikTok and YouTube as well. Put yourself in a wealthy environment. Go to one of the fanciest hotels in your town and have a coffee or tea there and just hang out. You want to soak in the abundance and prosperity, and you want to build a healthy relationship with money. How do you do that? Care about it. I was networking last year after I'd given my TEDx talk, giving somebody the QR code to watch for free my TEDx talk, and she said, I don't need that. I don't care about money. But if you don't care about money, it's not going to care about you. Think of it as your friend and build a healthy relationship with money. You can talk to it, and it may talk back to you. I just completed Cliff Notes on a book called Messages from Money by a good friend of mine, Ellen Rogan. If you want the Cliff Notes, let me know. I do Cliff Notes every week in my weekly email, by the way. And so I read a book a week. And in this book, Ellen channels the entity money. And she gave us messages from money. So Tyson, could I share my screen and show some slides?
You may. Just made you co-host.
Thank you. So I'm going to rely on Tyson to answer questions. Sorry. Show the questions that have been asked.
Sure.
So let's get comfortable investing in stocks. So I already did a little bit on my background and expertise. So let's go to the disclaimer. You're here to learn about how to invest in stocks. There are many ways to become prosperous, abundant, and wealthy. This is just one. And here's just a sample. You can invest in real estate or crypto or stock options. You want to get rich in your business, do that. Create a new business, invest in stocks or bonds. You can generate royalties from an online program of books. There are many, many ways. This is just a tiny, small little sample. So I'm going to be teaching you one way, but I will tell you right here, right now, you have to believe it. You have to believe that you can become wealthy, abundant, and prosperous by investing in stocks before you start. I ask every client before they come to work with me, what's your belief level that you're going to get 100% return on your investments in 1 year? Most people say, no way, that's impossible. Then I ask them, what about 50%? What about 30%? What about 20%? If you don't believe you can outperform the stock market by using my methodology, then I don't want to work with you. Because belief is critical. So hopefully you believe that this process works. I think Tyson said when he posted, he found the stock. How much has it been up since you invested? 80%, something like that?
Yeah, something like that. Because I had a very similar belief. I got taught, oh, no one beats the market long term. And Joel's like, yeah, but who wants you to believe that? You know? And we went into, a lot of the stats and he showed me how to do this. And my belief level changed. And I guess that's what allowed me to invest in some of these companies. And then of course receive the benefit on the other side where it is beating the market. So
yeah,
that's just been my
absolutely.
experience, everyone.
So I will tell you, as Tyson said at the beginning, I'm not sure if we was recording at the time, but he said at the beginning that the purpose of this methodology is put the odds in your favor, right? So you want to get the odds in your favor so that the likelihood of you generating an above average return is very high. And that's what this process does. So I'm going to be teaching you today the 5-step stock screen. And some of my clients just use this 5-step proprietary stock screen to which I taught Tyson as well. We're not going to get into price targets here today, but the idea, I want you to find a stock that passes the 5-step stock screen, and say if it's at 50, I want to find a stock that's worth 100 or more. So it has 100% upside. 50 to 100 is 100%. And I want to find stocks that have at least 100% upside and less than 20 or 25% downside. Meaning that the upside to the downside is heavily weighted to the upside. But we're not going to get into that today. We're just going to talk about the 5 steps. So let's start basic. What the heck is the stock market? So put in the chat which one you think the answer is. Is it a place to buy stocks? A way to make a lot of money? A place to speculate? 4, it's where people go to buy and sell stocks or shares in public companies. 5, it's rigged. Which of those do you guys believe it is? So I got a 4. I got a few 4s. So I will tell you the answer is 1, 2, 3, and 4. And hopefully you didn't put in 5. I did have somebody, when I gave a presentation right after my book, The 9 Money Rules Millionaires Use, came out in 2019, tell me that the stock market's rigged. So if you believe that, don't invest in the stock market. Don't do what I'm about to teach you, because your belief level is so low that you're going to be losing money. I know it sounds controversial, but it's true. And the last chapter in my book, The 9 Money Rules Millionaires Use, is, can real estate make you rich? And I start that chapter. Oh, thanks for showing that, Tyson. Yes, that's my book from 2019. And in that chapter, I say, if you don't believe real estate can make you rich, skip this chapter. Because we go back to rule number 1, when you believe. I don't want you investing in things that you have no belief that you can make money in. So that's the stock market. So why do you want to invest in the stock market? Here's some answers. Possible answers. Love to hear your views. So one is you can become financially free. The average return here in the US, at least since 1970, has been about 10%. So that compounded $10,000 US would be $1.2 million today. That's the power of compounding, also known as compound interest. Another answer is you will outpace inflation, which is hurting your cost of living every year. In fact, it's been quoted at 3% recently. I don't believe it, but even if you use 3% here in the US, money will double in 24 years. So you have to pay 2 times for the same dinner in 24 years. Another answer is it's easy. Do you believe it's easy? Answer number 4 is there's no commission costs. So pretty sure this is global now. It started in the US about 10 years ago. Commissions went to 0 from all the major brokerage houses. I think that's true globally, but let me know if that's not true in your neck of the woods. And you don't have to pay taxes until you sell. It's great. I'm not going to go through this vocabulary. I have in this slide, and Tyson, if you want, I could send you the slideshow and you can share it with everyone who's here. So there's balance sheet vocabulary. We go over income statement vocabulary, also known as a summary of operations. And let me just jump here to valuation ratios, and then we'll get into the 5-stack stock screen. So book value. So we need a few terms that are absolutely necessary for the 5-step stock screen. This one's not, but we use it in our price target methodology. So book value is shareholders' equity. That's how much on the balance sheet a company is worth divided by the shares that they issued or the shares outstanding. So, and I'm not going to go through these numbers. This is an example from Apple. You may have heard this company. It's a small, tiny little company, Apple. I think it makes some phones and some computers and some iPads and some AirPods and stuff like that. So I'm not going to go through those numbers, but I'll just show you the calculation. So E, or EPS, is earnings per share, or just earnings. The professional investors just shorten it to earnings. So EPS is the net income. So it's the revenues minus the expenses, how much money the company made in a particular quarter or particular year, divided by the number of shares outstanding again. And 2 valuation metrics we use a lot is the price to book value. So price of the stock divided by the book value, which we just calculated above, is the equity per share. And then the price to earnings ratio, or the PE. So generally we don't say P/E or P divided by E, and we don't say P divided by book value. We just say price to book value, or PE, or PBV.
So let me ask you,
the
Joel,
PE,
when people are hearing this, what exactly do those things mean? Like, why are you working these things out?
Yeah, so this is a way to value a company. So what you want to do is compare the price to book value, the price to earnings, to prior ratios. So you want to see if the company is expensive or cheap based on these ratios, or you want to see if it's expensive or cheap compared to other companies. So for example, if the PE, so we see here with, so let's start with price to book value. So the calculation for Apple on October 20th of 2020 was 26.95. So that in a vacuum, we don't know if that's high or low, right? But we calculated that number. So we could check to see where Apple is today on the price to book value, where it was a year ago, 2 years ago, 5 years ago, 10 years ago, and then compare the numbers and see if it's expensive or cheap. And then we could do the same thing compared to Google and Microsoft and Samsung and other companies and see if they're higher or lower. And I'll show a slide next that shows how it compares to other companies. It's called a peer comparison. Their peers or the other companies in their industry. And you can do the same thing with the PE. So you see here the PE is depending on how you calculate 35.8 or 30.1. So again, that's a vacuum. We don't know if that's high or low, but let's compare it to where it is now, where it is a year ago, 2 years ago, 5 years ago, 10 years ago, and see if it's higher or lower. If it's higher, it's expensive. If it's lower, it's cheap. And we can do the same thing comparing it to Google and Microsoft. So here on this slide, here's the peer comparison. So we see the PE for Apple is 30. And at this time, Amazon was 101.9, Google was 34.69, and Microsoft was 33.29. So Apple was had the lowest PE of all these companies, and the average was 50. So on this basis, it's cheap. And on the price to book value, Apple was 27, which is higher than Amazon, Google, and Microsoft on the average. So we have two valuation metrics, PE and price to book value. One says Apple's cheap, one says Apple's expensive. What do? Well, we use the 5-step stock screen. So let me just give a quick overview of what that 5-step stock screen is. It is using fundamental analysis, which means that we're using the values of the company, how much money they made, how much sales they made to determine the value. Does that make sense? So we're using the valuation metrics, PE, price to book value, cash flow, these kinds of metrics to determine if the company is expensive or cheap.
And for those who are just diving in here, Joel,
Yeah.
with understanding all of this, what helped me really understand is that if we're to make money in the stock market, we need to find those companies that are, as Joel said, that are likely to go up 100%, right? So we're trying to find those diamonds in the rough. So they're not the companies that are going to accelerate. They're the companies that are more likely to accelerate that people don't know about.
Right.
Does that make sense, everyone? It's understanding that if everyone knows that a company is going to skyrocket, then that's going to reflect the price, right? So we obviously not going to get a huge return on that because it's already known. What we're finding out here is what companies, based on the fundamental analysis, are likely to accelerate, are likely to where the price is likely to double, that people don't know about it yet, right? Because not everyone's going to go through a stock screen and take the time to actually go through the fundamental analysis. So we're trying to find those diamonds in the rough that people don't know about yet, so that we can basically buy it when it's cheap, and then sell it after it skyrockets. Is that right, Joel?
Correct. Yes. So, and I was talking to a prospective client this afternoon, and I explained to him that it takes patience, because here in the US, there are 5,000 companies. In Australia, it might be about 1,000. Not every one company is going to pass the screen. And the reason is because not every company is going to go up a lot. And it's not the diamond in the rough. So it may take 20, 50, 100 companies to find one that passes. And it takes patience to find that one, because that one is the one that's going to make you money. Mm-hmm. And the reason why not a lot of people are making 100% on their investments is they're not doing the work. They're not spending a little bit of time. And like Tyson said at the outset before, I think the recording started, you can, once you get good at this, I had a client 4 or 5 years ago. He was doing everything by hand. He didn't know how to do a spreadsheet, every calculation by hand on a piece of paper. And it took him over an hour for one company at the beginning. Everything by hand. I had to show him multiple times where to find the numbers on the internet. And then he did the calculations by hand. Eventually, I taught him how to use a spreadsheet. He put the numbers in a spreadsheet. He automated it. And now it takes him less than a minute. He's looking at 5 numbers or 6 numbers. and putting them in the spreadsheet, and it automatically calculates pass or fail. So technical analysis is just looking at the stock's price, and technical analysis comes in on step 5, which we're looking to see if the stock went up or down on the day of earnings, and I'll get to that in a second. Chart and comparing that price chart or the stock's price today to past prices. So we're looking at moving averages, and I'm not going to go into all of this, but basically technical analysis is just looking at stock prices. It's not looking at how much money the company made. So let's get into the 5-step stock screen. We're looking for companies to pass all 5 steps. And if it passes all 5 steps, you may have a winner. Again, this puts the odds in your favor. And the next step after this is to calculate price targets and see if the company has 100% upside. But this is the first step of a multi-step process. And like I said earlier, some people just use my 5-step stock screen, which is on pages 152 and 153 of the 9 Money Rules Millionaires Use. They just use that and they've made a lot of money. But I want you to get the odds even more in your favor so you can make even more money and also have the odds of losing money be much lower. So step 1 is to calculate the most recent quarter's earnings per share, the EPS we just talked about, and we want that EPS growth. So we're looking at the most recent quarter's earnings year over year. So I have an example here, and then we want to see if the EPS growth is at least 10%. So the idea is we want companies that are growing their earnings, not companies that are not growing their earnings. And I picked, I put a finger in the air at 10%. I don't want single-digit growth. I want decent growth for the earnings of the company. So my example here is in the second quarter of 2018, Amazon, AMZN, stock symbol, had EPS $5.07. And in the year earlier, same quarter, we compare year over year for the same quarter because there can be seasonality. Amazon actually makes a lot more money in the fourth quarter of each year than that's the months of October, November, and December than any other quarter because of the holidays. A lot of people buy a lot of gifts in the holidays. So they make most of their money in the fourth quarter. So if we were to compare the second quarter of 2018 to the fourth quarter of 17, they might not have any growth at all. It might be negative. So you compare, because of seasonality, things going on in the same quarters year after year, we compare the same quarter for the prior year. So for the second quarter of 2018, Amazon had EPS of $5.07. The second quarter of 17 had EPS of $1.25. So the EPS growth was 507 divided by 1.25 minus 1 is 306%. That's huge. So 306 is greater than 10. So they passed step 1. Any questions about step 1? So step 1, we're looking at earnings. Step 2, we're looking at sales or revenues. And we want to calculate the most recent quarter's sales growth year over year and see if it's more than...
I interrupt for a second. I did have a question.
Yeah.
So
Yes.
if you go backwards, back to 2016, 15, 14, is that a trend, or is this for Amazon, for instance? Is this a momentary glitch in time? They always say, current earnings are no guarantee of future earnings. I'm just wondering if you look at that kind of analysis, would you do it over multiple years or multiple quarters?
Great question. So we're using the most recent quarter. So right now, we're just ending the second quarter of 2024. So if we were to do Amazon, we don't have second quarter 24 yet because they'll report the quarter ends June 30th. They'll report probably July 15th or July 20th. So right now, we would be looking at the first quarter of 2024 versus the first quarter of 2023 and seeing if they passed their last quarter that they reported. In this analysis, we're not going backwards. We're not looking at 2023, 2022, 2021. We're just looking at the most recent quarter. And some of my clients look at the future quarter based on the analysts. There are a lot of analysts who work at investment banks who try to predict how much money a company's going to make in the next quarter and how much sales they're going to have in the next quarter. So we can look at steps 1, 2, 3, and 4 for the upcoming quarter based on the analyst estimates and use that information as well. But we don't look back. I don't really care about 2023 or 2022 or 21.
And then my next question is that earnings growth and the value of the share, the current share price, is that not often factored into the share price, so that when they do declare earnings, it doesn't really move the needle that much on the share price? Or is that just me watching the wrong stocks?
So these 5 steps generally predict how the stock's going to do over the next 3 to 6 months. And if they pass the 5 steps, the stock generally outperforms over that period. And if they fail the 5 steps, it generally underperforms. So the whole point of doing this is to get an indication if the stock's going to outperform or not. And I will say that no, the information generally what we do is when I work with clients, we're looking at companies that are reporting their earnings that day, that week, that month. And so like next month, the clients I'm working with, if they're invested in the stock that Tyson talked about, First Solar, that's up 80%. When they report in the end of July, we're going to be looking to see if they passed, again, their 5 steps. And that way, that will say to us, okay, we own it. Let's hold it for another 3 months because it's passed. So I don't know if that answers your question, Hans.
Yeah, that's very good. Thank you very much, Joel. Sorry to interrupt, but that was good.
No, we welcome questions. Please ask more. So that's step 1. Step 2 is to calculate the most recent quarter's sales growth and see if it's more than 5%. Again, this is a little bit in the air, but we want, sticking a finger in the air, but we want companies that are growing their sales. And we'll get to step 3 in a second, but we want the earnings to be growing faster than the sales. So that's what I did, 10% and 5%. So for the second quarter of 2018, Amazon had sales of $52.9 billion. And in the second quarter of 2017, it had sales of $38 billion. So if we divide 52.9 by 38 minus 1, we get 39%, which is, again, huge, more than 5%. So it passed step 1 and step 2. So, by the way, I have a mastermind group that I work with now, and we have a spreadsheet, a shared spreadsheet. So you would be putting in numbers into a spreadsheet. The spreadsheet automatically calculates if it passed or not. So all you have to do here is put in 2 numbers for step 1, 2 numbers for step 2, and it'll calculate step 1, step 2, and step 3, because step 3 is step 1 greater than step 2? Well, we saw step 1 was 306%, and step 2 was 39%. So yes, step 1 is greater than step 2. So why is this step important? We want the company's earnings to be growing faster than their sales. Because think about it, if their earnings are growing faster than their sales, if they sell the same amount, say in your business, you sell $10 million in the quarter, and the next quarter you sell the same $10 million, but you earn $3 million in this quarter compared to $2 million last quarter, what happened? You're charging more per widget, or coaching, per whatever you're selling, per Aussie dollar per Canadian dollar of what you sold. That's really good, right? Your margin is expanding, which that's what we want. We want companies to sell the same amount or about the same and make more money. So they're charging more. So they're raising their prices. So that's good. So that's what we're checking for in step 3 is, are they earning here? And here they earned 306%. The step 1 earnings grew 306% and step 2, 39%. So that's an easy step. That makes sense, right? Great. So step 4, maybe the most complicated, I guess, of the 5 steps. Now we want to see, is step 1 greater than the price to earnings ratio? Remember, we defined the PE as the price divided by the earnings per share. So we know that the EPS in step 1 was 306% or 306. So now we have to calculate the PE. So we need the price of the stock of Amazon. So generally, we're doing this on the day the company reports their earnings. So Amazon was trading at 1,808 at the close of business on July 26, 2018, when they reported. They reported in the morning that day. So then we take the 1,806 and divide by 4 times the earnings for the quarter, because we want to get a full year's worth of earnings. So we're getting 4 quarters worth of earnings here. So generally, PEs are calculated based on the price divided by annual earnings. So that's why we have to multiply by 4. So the PE is 89, and the EPS growth from step 1 is 306. So 306 is greater than 89. And this is an indicator of if the stock is expensive or cheap. If the earnings per share growth is greater than the PE, then it's growing faster than it's valued at. That's what we want. We want companies that are growing really fast compared to how they're valued. So Amazon passed step 4 as well. The EPS growth is 306, the PE is 89, 306 is greater than 89. So now we're getting excited. We got a company that passed all 4 of the first 4 steps. Let's look at step 5. Step 5 is really simple. We look at, did the stock go up on the day of earnings? So here on July 26, Amazon stock actually went down 3%. So it failed step 5. Now we do this because this step is really important, because when a company reports their earnings, a lot of information is being assimilated. There's many analysts from the investment banks and broker dealers that cover the company, and they may be upgrading the stock, downgrading the stock, increasing their earnings estimates for the year, for next year. There's a conference call that goes on with the analysts on the day of earnings. The analysts asking lots of questions to try to determine if the stock is expensive or cheap. And all this information is getting assimilated into the stock that day. So this is a way to assimilate all that information into one number. And we look at how the stock did that day. And unfortunately, Amazon went down. Even though all these other numbers were great, what it was saying is, well, it's already assimilated into the stock, all those good information, so the stock went down. Now, here's what's interesting. The stock failed. Over the next year, Amazon stock dropped 26%, and the stock market was down 17 here in the US. So we really want to focus only on those companies past all 5 steps, not 4, not 3, not 2, all 5 steps. So that's the 5-step stock screen. I'm not going to go into price targets because I didn't think we were going to have a ton of time. We only have 13 minutes left.
Can I have another quick question, Joel? So was
Yes,
that a
please.
surprise? Was that a surprise? Because it speaks to my first question, which was when stocks don't go up on earnings report, obviously the analysts figure it's priced right, or it's probably not worth it. So I'm glad that step 5 stopped people from continuing to invest, but does that not also sort of drive the stock down if indeed everything else looked pretty good for the company?
Yeah, great question, Hans. So we don't know exactly why. It could have been that Amazon said, you know what, next quarter our earnings are going to go down. Or they might have said, you know, book sales are weaker than we're expecting so far in the quarter. Or they might have done, you know, just said, you know what, this is again, right? We don't know exactly why the stock went down, but it's not a good indication of the future 3 months, 3 to 6 months. So that's why we're looking for stocks going up and having the other 4 steps pass. And then, you know, here with price targets, we want to find a stock that has a price target of at least 100% upside. There's a few steps that go into price targets as well. And if anybody's interested, we can jump on a one-on-one call to discuss that.
Or do you want to come back on here, Joel? Do you want to jump on another group coaching call?
Yeah, I mean, I could do price targets as well. That will probably take another 30 minutes or so.
Cool. I'd be happy to do that if you guys want to come back and learn about price targets. What Joel's finding out here in terms of the information is pretty easily available, isn't it, Joel? All you have to do is if any of you already are investing in companies and in stocks, all you can do is just do a research, right, Joel? Of just do the investor relations for that for that company. Just do the company and then do investor relations and look at the last published quarter, and then all the information will be there, correct?
Yes. So all this information is online. So the first 2 steps, finding the earnings and the revenue growth, are from the company's investor relations press release from the most recent quarter. And then step 4 is we need the price. You can get that from Yahoo. And then also on Yahoo, you can see how did the stock do on the day of earnings. So you could go to Yahoo Finance and say, okay, Amazon reported, you know, it's July 15th. Let's see how the stock did on July 15th. They have historical data. And also, if we're looking at, you know, it's a day later, you can go back and look at the prior day and say, okay, how did the stock do on the day of earnings? So yeah, all this information is publicly available. You don't have to have, you know, Vanguard or Fidelity or any of these brokerage sites to get this information. All of it's either on the company website or on Yahoo. So I did want to just let you know that I'm no longer offering. Tyson took my Fast Track Prosperity one-on-one coaching. So I'm not actually doing that anymore, but if anyone's interested in it, I'm going to reopen it for 3 people who are on this call today. And if you want to chat, I'll put the link in the chat to jump on my calendar. The other option, which I already mentioned, is, you know, I started last month a brand new stock investors mastermind group, and we meet twice a week. We have accountability partners, and for you guys, the next 9 people, I'm giving it 50% off the normal investment in that program. So you get to hang out with other people who are doing, you know, who are calculating the 5 steps together. We're all working together to create abundance and prosperity as well. So love to have you guys join that if you're interested. So let me just conclude with, you know, there is a nomenclature to understanding stocks. We talked about PEs and price to books and EPS. No need to memorize anything. You know, you get the presentation, and, you know, you can just, you know, go over the meanings of these at your leisure. I had a client I've been working with this year, and, you know, she found a stock that's up 88% in 3 months, and she's still not like 100, you know, what's a PE? She asked me last week, you know, so she's still getting to know the nomenclature, but you can be an amazing investor. Rule number 2, by the way, in my book is trust your intuition. You can be an amazing investor by finding a few stocks that pass and trusting your intuition. Yes, Rosemary.
So this is a question from somebody who's very ignorant about, oh, geez, I lost you guys. Is there a set, like, so when you're buying stock, is there a minimum and a maximum that you can purchase stock?
Great question. And know that there's no wrong questions except the ones you don't ask. So here in the US, there's no minimum. You could buy stock for a few $100s. In fact, I had my daughter start a TD Ameritrade, which became Charles Schwab account, and put a few $100s in just to play. You know, just start playing with a few $100s and get comfortable hitting that buy button or hitting that sell button. Sometimes it can be a little scary to do that the first time, especially with millions. Just kidding, but if you had a hedge fund, you would be starting with millions. So yeah, here in the US, there's no minimum. There may be for some brokerage accounts, like if you're working with a high-end brokerage account like Morgan Stanley, Goldman Sachs, they may have a minimum. But you can find accounts like a Charles Schwab or E-Trade or Scottrade or something here in the US that there's no minimum. So I'm gonna, here in the chat, I just put my calendar if you guys wanna sign up for a discovery call. Be more than happy to go in more depth. And if you have any questions on, you know, those 3 slots for the one-on-one coaching. Oh, Linda Joy, I see you have a question.
Hi, thanks, Joel. Just going back to what you said is to check on Yahoo. I'm just curious, is there different information and stats when you're doing your research from Yahoo to Google to maybe all the different providers for the, do you know what I mean? Like,
yes,
are they
great
providing
question.
all the same information? I mean, I Google, but see, I use Google Chrome. So if I use different platforms, will I receive different information?
Great question, Linda Joy. It is possible that you can receive different information on different platforms. So that's why I prefer to go to, like Tyson said, the investor relations page of the homepage of the company itself, because there may be human error. You know, it's not all AI yet where they're grabbing the actual income statement from the company and pulling it onto like automatically. There's humans that are actually typing in numbers that can be mistakes. So there may be, you know, errors potentially in Yahoo versus on Vanguard or Fidelity, these other platforms. So that's why I like to go right to the source. So they put out the company puts out a press release. That's the official numbers, right? And I go to the table where they have their earnings and their revenues and just look at that, not look at all the printed numbers. It's the table. And so, you know, for the actual stock price, that's when I go to Yahoo, because that's an official, the company or Yahoo or Google or whatever can't change what, you know, the stock traded at. So those are official numbers. So that's where I use Yahoo for the stock price at the close of the day or on the day they reported earnings. So great question.
Okay. Thank you. Another quick question in regards to crypto. I think I might have. Is there I think you said you don't do crypto advice. Is that right? Or
No, I
if
didn't say
so,
that.
can you do a training on that?
Well, crypto, I can do a training on that. Cryptocurrencies are not fundamentally driven, meaning that there's no way to figure out how much money like a company is making. Bitcoin is traded based on price and volume. So you can do all the technical analysis that I do for individual companies technically, which is looking at moving averages, looking at the relative strength, looking at fear versus greed, but there's no quote unquote fundamental reason why the Bitcoin or Ethereum or Algorand is trading where it is. It's all based on technical analysis.
Okay.
And we
Yeah.
can do that. That's fun. And I do help a few of my clients with crypto portfolios that they have, but we do technical analysis.
Okay. Thank you so much. Thanks,
Sure.
Joel.
Yeah, we can't use the 5-step stock screen for crypto because it's stock based. I do have a 7-step real estate screen that we use for real estate. That's also in the book that Tyson mentioned.
Beautiful. So we'll have to wrap up in a couple of minutes. We've got the collaborative call in about 7 minutes. I'll put the link to the collaborative call in the chat here if you guys need. Joel, this has been awesome. I know this is quite a lot for people, but I want to make it pretty clear that if you want to invest in stocks, you can easily grab just sign up to an app or a platform, a trading platform. I did it pretty easily. And even though I'm in Australia, I do interactive brokers, and you can invest in stocks in the US and everything else. And some of it, like the platform I use, is free, and it's pretty easy to just look up the stocks, go through the stock screen, invest in something, and just get your feet wet. Go through this call again. Reach out to Joel if you got it. If you have other questions, and if you want to dive deep on this. And what I really went all in on is, hey, if I can just learn this and I get really good at just plugging in some numbers, all of a sudden I'm a really good investor, right? All of a sudden I'm now confident in my investments. That's worth a lot. That really is worth a lot. I see hands. You got your hand raised?
Yeah, so my early days of investing when I started working at Agaron were really heady days where I sort of made a heck of a lot of money on Qualcomm and then lost a heck of a lot of money. So the secret there is always know when to buy and when to sell.
Yes, setting the price target.
Exactly. Sort of the really good. And so that's why I don't do it anymore. I have experts like Joel do my money investing for me because first of all, I have other things to do with my time, and I'm not the expert in it. You focus on what you do best, and for the rest, you make a call and you write a check to Joel, or you give him part of your earnings, because then he will be more disciplined about when to buy and when to sell.
Yeah, to be clear, Hans, I don't take anyone's money. I just coach and teach.
Yeah.
So no, I'm not a financial advisor, financial planner. DIY rule number 8. And I actually believe that you all are brilliant intuitives, and you have the ability to do it yourself. And you can find these opportunities where you'll make a lot of money. And just back to Tyson's point, it is really simple to open up an account. If you haven't opened up an account, you want to jump on a call with me, I'll help you open up an account in 15, 30 minutes. Really simple.
Oh, yeah.
Do
Thanks,
you have
Joel.
any platforms that are your favorite for that?
Again, I'd say rule number 2, trust your intuition. But, Interactive Brokers is great. Charles Schwab is great. But, go with what feels good for you. I'm all about feeling first, manifestation second. So trust your intuition.
Thanks, Joel. We'll wrap it up
Thank
there.
you, Tyson, for having me.
Everyone reach out to
Appreciate
Joel. If we can invite you back to do the price targets or do other topics, that would be great. But everyone reach out to Joel. Thank you for coming on and showing everyone how to go through this. Take some steps, take the time to learn, and we're here to help. So thanks, Joel. Thanks, everyone. Appreciate
Thanks,
you.
Tyson.
Thank you.
Have a call, everyone. Take care.